Thank you, everybody, for joining today. I'm a partner in the Tax Credits Incentives Advisory Group. I'm based out of our office in the DC area, in Tyson's Corner. This is going to be good, I hope, for everybody, because we have seen this to be perhaps the most popular and most heavily marketed incentive program, and probably longest lasting as well in terms of how long you can apply for it from a statutory perspective. It's a payroll tax benefit that's been around since COVID started to hit back in March of 2020. And so the goal today, the title is you have one more year to apply for the 2020 ERCs. You do. Subtext, you have 2 more years to apply for the 2021 ERCs. And I'm saying ERCs, not ERC, as many people do, because there are actually 4 separate and distinct employee retention credits, 3 in 21 and 1 for 2020. But we'll talk a bit about the history of the program. I'm going to talk a good amount about what the environment is out there with respect to ERCs, and it's just how heavily marketed it is, and maybe things to be wary of as well as you think about it. But most importantly, it is still available to you if you haven't claimed it. It is something that we here at Cherry Bekaert will be happy to discuss with you and talk about the position to the extent it's something you want to look at. But again, we're going to go through everything from when it began to how it's evolved, the difference between the 2020 and the 2021 credits, and then we'll get into how you qualify and if you qualify, and then some of the mechanics under how you calculate both whether you qualify or not, and then how you calculate what the credit is. And again, these credits are payroll tax refunds that 9 times out of 10 will come back to the employer in the form of a check from the IRS. Most of them need to be done via a paper filing. There is not an electronic filing avenue for a lot of this to be done as well. So there's actually a slow roll when it comes to doing the application, putting in the amended form 941X, and then it's a waiting game for the IRS to take a look at it, process it, potentially issue the refund, but then keep in mind that you may still be subject to examination after you receive that refund. So it's very important that we here, when we do work on these projects, can document that you are an eligible employer and that we calculate the credit correctly, and we'll be ready if the IRS were to have any questions. So let's move on. All right, polling question 1. Everybody remember to answer at least 3 of these things. So how did you hear about this webinar? A Cherry Bekaert advisor, an email from Cherry Bekaert, friend or colleague, Cherry Bekaert alum, or on a social media post. And we're not even going to share the results after these. We'll just move on after you give it a minute to in there. It's interesting as well. I see social media posts. You've probably seen a lot of social media, YouTube videos, TikTok videos, even, I don't know, around the employee retention credit, because again, it seems to have attracted a large number of, we'll call them, maybe not pop-up shops is the right word, but people who are new to providing tax relief to taxpayers who've gotten into offering ERC consulting services. All right, let's move on. Okay, the ERC from the CARES Act to today. So keep in mind, this came out March 23rd, 27th, maybe, of 2020, effective as of March 13th, 2020. So the original employee retention credit was a 2020 only credit that began March 13th through the end of the year. And at that point, it was, if you didn't qualify for PPP, it was something to take a look at. Later in 2020, it was both amended and expanded such that you could claim it if you got PPP. So keep in mind, even if you got a PPP funding, you can still take advantage of the employee retention credit. The most important thing there is to, and this is what we do to make sure the credit's maximized, make sure you're not incorporating any wages funded by PPP in the ERC calculation. That'll be like one of the #1 questions the IRS asks, is to make sure that there's no double count there. But beyond that, at the end of 2020, it was expanded ultimately into 3 more quarters of 21, originally 4 quarters, and they pulled 1 back. But so there's a separate ERC for the 1st, 2nd, and 3rd quarter of 2021. So again, that's 4 employee retention credits. there was some expansion made as well to some government-owned entities like colleges and universities, as well as hospitals as well that could take advantage of it. I want to also point out that this is a benefit that's available to employers. It doesn't matter if you're a nonprofit or a taxable entity. And most importantly, and it's not stated explicitly in these slides, but the ERC is taxable when not necessarily when received. It actually is treated as you preclude the ability to take a deduction for the wages that go into the employee retention credit. It's basically the same amount of the credit, you have to reduce your deduction. So for example, if you got a 2020 ERC of $500,000, you would have to reduce your wage deductions in 2020 by $500,000, which means that taxable income increases. And to the extent you're an S Corp or a C Corp, you may have to go back and do an amended return. If you're a partnership, you may be able to do an administrative adjustment to take advantage of that, or sorry, to compensate for that. With that said, I just want to make sure, because this is lost oftentimes. The ERC is taxable, and it's taxable in the past. So it's something to keep in mind. It's not when you get the check, it's really when you submit the claim, you are precluding your ability to take a wage deduction in those years, either 2020 or 2021. All right, let's move on. Excellent. Polling question 2. Was your business impacted by government shutdown, COVID-related mandates in 20 or 21? We're going to talk a lot about COVID-19 orders. One of the rules for the ERC is that to the extent there was a COVID-19 order limiting commerce, travel, or group meetings, and it caused what's known as a partial shutdown on your business, which is something that we can attempt to measure as well. Even I'll answer the polling question. We'll share the results here. All right. Was your business impacted? Yes. Most people said yes, 55%. What we see is that certain businesses are deemed essential, and so they weren't directly affected by COVID-19 orders, but maybe their customers were, and that's something we'll talk about. All right.
Marty, I want you just mentioned essential businesses.
Yeah.
Can you talk a little bit about what we're seeing from state by state and how essential businesses may be classified differently in different states?
Yeah, absolutely. We see a lot of construction businesses deemed essential throughout the country. We also see oftentimes like hospitals are essential, but maybe not a certain portion of certain surgery, certain types of activities at hospitals. But most importantly, beyond the essential business designation, we're going to talk about these COVID-19 orders. And they are often state by state analyses done. And so I would say you see in the South, there was an attempt to shake off some of the COVID-19 orders earlier than you'll see in some of the northern states. California has some pretty heavy mandates as well that lasted for a long period of time, but you move down to places like South Carolina, and we see most of the COVID-19 orders ending around October of 2020. The other thing that I want to talk about as well is, and I've seen certain providers try to utilize CDC and OSHA guidance as a government order. It is not, unless it is specifically adopted by the state into a COVID-19 order with respect to some of the, we'll call it distancing or regulatory requirements of those. So just having the fact that there are OSHA guidelines or CDC guidelines out there is not enough unless specifically adopted in there. Again, every state's different. And so we will look to see whether the business was classified as essential or not. Many of the business owners know that because it was very important at the time. So when we talk to our clients and to new potential clients, we're always asking them, what was your story back in 2020 when COVID first hit, and how did it affect you? Okay, from an employee retention credit perspective, again, there are 4 credits, 1 for 2020 and 3 for 2021. These are payroll tax refunds available to what's known as eligible employers. And we'll get into what that definition is in a bit. Again, credit for 2020 is for wages paid between March and December of 2020. And then the credits for 21 mirror exactly the length of the first 3 quarters individually of 2021. So the credit for first, second, and third quarter. The maximum credit in 2020 is 50% of the first 10,000 of wages plus healthcare expenses paid to any of the employees while you're an eligible employer. We'll get into that again, but that maxes out at 5,000 per employee for 2020. In 21, it's 70% of the first 10,000 paid to each employee, or that will be the maximum amount. And so that would be 7,000 per quarter or 21,000 per employee. Again, I've seen this marketing out there, like you can qualify for $26,000 per employee. Not necessarily. It's broken up into component parts. That would be the maximum. But again, you can look at each individual period, credit generating period separately. And while you may not qualify for one, you may qualify for another. So, and just qualifying for one doesn't mean you qualify for the others as well. With that said, that's sort of the mechanics of the 2020 versus 2021 rules. Let's move to the next one. Okay, here we go. How are you an eligible employer? There are rules for 2020 and 21. They're close to each other, but a little bit different. Generally speaking, you are, yes, it should be through 21, not 22. Thank you. Generally speaking, you can qualify in one of two ways. One, you can demonstrate that you were partially shut down due to a COVID-19 order limiting what we'll call commerce, travel, or group meetings. And with some indication that it had a more than nominal effect on your business. And so having this imposition by the government on you, basically shutting you down partially, the government's paying you back for keeping people employed during that time. That's the theory here behind this credit. To the extent you didn't have a COVID-19 mandate on you, but maybe your customers did, that would be measured through a decline in sales, which is known as the gross receipts test. So in 2020, to the extent in any of the quarters of 2020 compared to the same quarter in 2019, if you had a more than 50% decline in your gross receipts, then you automatically qualify for the employee retention credit. I would say that that's not that common. That's why we find, that's why it says more common government mandate test above. In 2020, we deal with more companies that are qualifying due to the imposition of COVID-19 mandates upon the business, as opposed to these more than 50% gross receipts declines. And if you qualify in one quarter in 2020, you will get the following quarter as well, and you could get a third depending on how much your gross receipts come back over time. But you probably will have maxed out the credit anyway, to the extent you get successive quarters. All right, let's move on to 21. Similar rules in the sense that COVID-19 orders limiting commerce, travel, or group meetings on the business still will qualify, but what do we know in 21? Many of them were lifted. Many of them were lessened as well. So while maybe they were there, they stopped having a more than nominal effect on the business, or they weren't there at all. Again, we're thinking about things like not just work from home, capacity limitations, perhaps on a production line. And also what we'll talk about a bit is, to the extent you're either an essential business or not, if your suppliers had a government order imposed on them that caused a measurable supply chain disruption, and you can trace back who the supplier is and the actual mandate upon them, that may allow you to qualify as well by demonstrating that supply chain disruptions. Maybe you can show additional lead times and things like that with respect to providing goods or services to your customers. The gross receipts test, though, was made easier in 21. You only need to show a more than 20% decline. Say, for example, in quarter one of 21 compared to quarter one of 19, just having a more than 20% decline is enough to have you qualified. And again, gross receipts, a measurable, directionally correct view is what your P&L says, potentially what your sales are. But gross receipts, and we'll talk about this, is broader than that. It includes things like dividends, interest, rents, royalties, gains on sales as well. And so keep in mind that if you have your P&L and you show more than 20% decline, we just need to make sure that we look at all the potential expanded definition of gross receipts for this purpose. And so again, we'll see the gross receipts potentially be more common fact pattern, at least it was early on. I'm seeing it level out between maybe a tie between gross receipts and government orders in 21 due to a better and fuller understanding of the government, of the supply chain disruptions. I just saw a question that came in. When I say gross receipts, I mean billings. No, I do not. Actually, it's a great question. What it is you look, basically what would be recorded on your tax return, whether you're a cash or accrual taxpayer, you need to use that same method of accounting, and you're looking at your sales plus dividends, interest, rents, royalties, and other income. Basically, the receipts, all items of income coming into you need to be considered, because the whole point here is to evaluate whether you have cash on hand to pay your employees, and that's what they're looking at under this gross receipts test. All right, let's move on. Okay, Carolyn, feel free to interrupt me if you want at any point during this thing, but we're going to talk about a partial suspension of a more than nominal portion of the business. When we consider these COVID-19 orders, if you look at the IRS notices, you need to have the government order cause what's known as a partial shutdown, and the definition of that is showing that the order has an effect on a more than nominal portion of the business. So to the extent there was a government order, it only affected a very tiny percentage, we'll call it like less than 5% of the normal business operations. That wouldn't be more than nominal. There's actually a safe harbor in the notice and in some of the FAQs previously issued as well, that you want to try to show that gross receipts from the portion of the business account for 10% or more of the overall business's operations in the same calendar year of 2019, or that your employees' hours were dedicated, at least 10% of the hours were dedicated to that portion of the business as well. So the classic example, a restaurant has a salad bar, the salad bar gets shut down. That's probably a more than nominal portion of the business. A salad bar inside of a grocery store is not. And so it's a matter of really understanding how these mandates affected the business and what portion of the business it affected.
Marty,
yes.
So 10%, so that's the safe harbor. What if I'm a company or a business and I can attribute, a 5% decline to a governmental order? Does that meet them?
It can, and 5% probably does meet the definition of more than nominal, but doesn't meet the safe harbor. So you really need to document that well. And I would say it's something to be prepared the IRS will ask questions about. And so we really need to evaluate exactly what happened there. And I also, when I look at these COVID-19 orders affecting the business, while you may not qualify for this, like the gross receipts test having a more than 50 or more than 20% decline, if you have some decline, that also shows a bit like that some portion of the business was affected. It's nice to pull as many data points together as possible. The orders, the portion of the business, what overall gross receipts effect happened as well. We'll try to pull as many facts in as possible.
So you mentioned documentation, and I know that we as a team just received our first ERC IDR, and they're asking for quite a bit of information, much of which I know as part of our deliverable, we already have prepared. Talk to me about documentation, especially when it's gross receipts is one thing, but when it's under a governmental order.
Yeah, for example, in that IDR, and it was no surprise to us because we were aware of some others that had been issued to some other firms and some other taxpayers. They're going to want to know, here's the question they asked, please give me a copy of the government order that was having a more than nominal impact on the business. It's important to note for companies that have, we'll call it geographic diversity, to the extent you have a government order in one location, that actually is treated as a government order on the entire trade or business, but we still need to show that it's affecting more than 10% of the business. Documentation is important. So yes, government order is step one. Step two is what's your story? Getting the facts well developed in terms of, okay, how did this thing affect me as a business or as an employer? What could I do in 2019 that I couldn't do in 2020 or 2021? Also, if I'm looking at the effects of a government order on my supply chain, who is my supplier? Where are they located? What is the order? Is it a US order or is it a foreign order? We can consider foreign orders as well when we take a look at this. So it's a storytelling exercise in my mind, sprinkled with facts that illuminate exactly how this business was affected. I don't know if you have any other thoughts there.
No, thank you for covering that.
Yeah, sure. All right, let's move. Okay, gross receipts. So we got a question about this before, but yes, we're looking at total sales, net returns and allowances, plus income from any other investments, including dividends, interest, rents, royalties, and annuities. In the taxable entity perspective, let's say a sale of assets, you reduce that by the basis in the asset, so it's true gain on that sale. This is different for tax-exempt entities. It's actually entire net proceeds from investments. And this is interesting as well because the gross receipts test is fairly binary. You either do or you do not qualify based on the math. And so it's important to keep in mind that you may have had some spike in income from an investment in 2019, early in the year, totally unrelated to COVID whatsoever, but you still might qualify just by virtue of the fact that like the rules are specific. They look back to what was happening in 2019 as we'll call it a base year pre-COVID. So that's the best measure they could come up with at the time. And so if, for example, you don't have a similar disposition of assets in 2020 or 2021, you may fall into the gross receipts test, irrespective of whether you had too much of a COVID impact. It's deemed to be due to COVID under the gross receipts test for this purpose.
Marty?
Yes.
Oh, sorry. What about other grants, COVID grants, restaurant revitalization, Save Our Stages, provider relief funds? How are those accounted for when you're calculating gross receipts?
What I like about your question is that you're reminding me of all the stuff I forgot to put in the slides. So this is good. All right. So with that in mind, in August of 2021, another notice came out indicating that specific grants, one being PPP, but others being restaurant revitalization, also shuttered venue grants as well, are not treated as gross receipts for this. So while you got an influx of help funds coming in from one of these programs, those particular 3 programs are not treated as gross receipts for this purpose. And that was not known until August of 2021. And that's why a lot of these are not being done until later on amended returns, because it wasn't clear that you qualified, because everybody thought the PPP would probably come in and be treated as gross receipts. Other federal grants, to the extent you're a tax-exempt entity that are covering wages, are treated as gross receipts for this purpose. So we have to look at the specific grant. Also, loans are not treated as gross receipts. So to the extent you received a loan, that would not be a gross receipt amount because you have to pay that back. But excellent question, and probably clarifying for everybody listening, because that's actually one of the biggest questions that the IRS had to answer. And they answered it not quite 2 years ago, but August of 21. Cool. Let's move. Okay, this is incredibly important. What wages go into the employee retention credit? It depends on whether you're what's known as a large or a small employer. Small employers get the benefit, the maximum benefits of the employee retention credit. To the extent you are a small employer, you can include wages you pay to everyone in the calculation. To the extent you are a large employer, this is a true retention credit in the sense that you are only allowed to include wages paid to employees who are not providing services. Basically, you're keeping them on the payroll and not throwing them off on the unemployment. And so for certain large employers, and the definition for the 2020 credit of large versus small is 100 on average full-time employees back in 2019. So what you need to do in the determination, if you're kind of on the edge and you don't know exactly where you are, you need to look at each month of 2019 and figure out a shorthand calculation will really figure out how many employees worked 130 hours or more in the month. If they worked 129 or less, they are not included in the number. And so you need to do that calculation every month of 2019, add them up, divide by 12, and that's your number. Again, small versus large is important for how many employees you can include in the calculation, and that is a 100 on average full-time employees in 2019. We don't look at full-time equivalents. We don't take 2 people and add them together and treat them as one. You're just in or you're out depending on how much you worked as an employee in that year. I have seen providers take the position that even for these large employees with thousands of employees, that all the PTO paid to these employees is treated as wages paid for not providing services. I think that's a very risky position. The IRS guidance explicitly says that does not qualify. So be wary of anybody taking that position. Let's move to the next slide and talk about the 21 rules. this is another reason why the 21 credits are so much more generous. A small employer was redefined to include many more employers, in the sense that you can have 500 or fewer full-time employees as measured in 2019 and still be treated as a small employer, meaning that you can include wages you pay to every employee in the calculation. So more businesses can max out at that $7,000 to $26,000 per employee for the 3 quarters of 2021. When I talked earlier about the gross receipts test, and there may be a slide on this later, but I'll just cover this now. When we look at the 2021 rules, you can look at the current quarter, say, for example, Q1 of 21 compared to Q1 of 19 to look for a more than 20% decline. But you can also elect, if that doesn't get you qualified, to use the prior quarter. So for example, in Q1 of 21, you can look to Q4 of 20 compared to Q4 of 19 as a proxy for Q1 of 2021. And what that means is if you actually in Q1 of 21 have a more than 20% decline, in Q2 you don't, you can use for Q2 your Q1 as your proxy for Q2. So it's there's a long way of saying if you have a more than 20% decline in quarters 1 or 2 of 21, you will get the succeeding quarter as well as qualifying. So you get 2 bites at the apple with one drop in gross receipts potentially.
Marty, I want to ask about employee count.
Yeah.
So say I have 485 full-time employees for 2021, but I have 300 part-time employees working less than 130 hours. Am I able to take the employee retention credit for those part-time employees?
Good question, because it's 19, not 21. So you have to look back to 2019 and do that count. But yes, if you have a number of part-time employees, again, you're just measuring hours by month. So you're not really going to look as much at the full-time versus part-time designation as much as you're going to look at how many hours each person worked in the month of each month of 2019. But generally speaking, yeah, you're going to be able to. So that's what we see a lot in these large restaurant conglomerates, where they have a very large number of employees in the thousands, but most are part-time. And so as a result, they're still deemed to be a small employer and can still maximize on these credits. Yeah, let's go to the next. And we addressed this. This is the specifics of what a full-time employee is. This can be a takeaway, but it had an average of at least 30 hours of service in the week or 130 hours of service in the month. And the point here below with some of that language, it's not equivalent. It's not full-time equivalents. Okay, controlled groups, very, very important here as well. We will talk to companies and they'll be like, look, my company qualifies. I have the declines in gross receipts, but I also own another business and that one doesn't. So let's just qualify this one. Unfortunately, for purposes of qualification and under the gross receipts test and employee counts, you need to look to see whether or not there is a business that is more than 50% commonly controlled among 5 or fewer individuals. So what that really means is you can't just look at, if you own 2 businesses, you can't really just look at one. Also, very important as well is to the extent you own the business more than 50% and your family members work there, generally your interests in the business will be attributed to them, so they are owners, and the credit does not provide a credit for not firing your family. So although many of us would like to, but with that said, keep in mind that like when you have businesses that have maybe 10 or fewer employees, but there's 4 family members on the payroll, your benefits may be much smaller than you think. And so our goal when we look at this is to I understand the ownership structure of the business, understand who the employees are at the business, who are family members of the owners, so that we can make sure that we're not overcounting employees. Let's move on. Okay, polling question 3. Did your business apply for and receive a PPP loan? Again, Carolyn reminded me to bring up a good point that PPP funding does not preclude you, 1, from taking an ERC, and 2, it's not treated as gross receipts with respect to your qualification criteria.
Marty, what's the craziest, zaniest ad for ERC that you've seen recently? I mean, I'm seeing an onslaught of these communications and.
Yeah, it's good. I mean, it depends. I've seen them, I've heard them on the radio. I listen to podcasts every night when I go to bed, and I think I'm at work because I hear the ads for employee retention credit, and I think I'm having a bad dream. So I don't know. I think that's my personal hell. But beyond that, it's not so much the craziest ads, it's how aggressive they are. And I would imagine 80% of the invitees to this have been bombarded with some amount of email traffic from some of the ERC pop-up shops, have heard a radio ad, have seen it on TikTok. I see it on YouTube all the time as well. And so I actually have to thank them because they've generated such a high interest in this that, many clients want to discuss the true merits of whether or not they qualify. So I thank them for doing all my advertising for me. But at the same time, here's what I see that's zany, where we will work with certain companies and make a determination that they don't qualify, and then they'll end up going out and working with one of these, another consultancy, and come back with a position that we can't support. And if they're, under audit or something like that, and we have to determine whether they can take financial statement benefit for the ERC, we cannot oftentimes. And so I'm called in to be a subject matter expert oftentimes on whether or not a company qualifies. And sometimes we can find independently that they qualify through some other way. We try to be advocates for our clients. At the same time, though, we have to often tell them some disappointing news that they probably shouldn't have taken this. All right, I'll leave it at that. Okay, let's move to the next. Okay, the point here is that you can claim both ERC and PPP. Mathematically, what we do, and let's think about the example. Well, let me restart. Let's talk about the fact that you can't double count, meaning PPP funding that covers wages paid to employees. Those wages paid to employees cannot go into the employee retention credit calculation. But keep in mind that the period of PPP forgiveness, PPP covered period, is generally, for most companies, about 24 weeks. And so there's a lot of wages paid over that 24-week period. And the PPP funding is generally less than that 24 weeks of wages. It's generally 8 to 10 weeks. With that said, there's generally leftover amounts of non-funded wages not covered by PPP. Even if you applied all your PPP to wages, due to the fact that that cover period is so long, there's probably a good amount left over that can go into the ERC calculation, but it has to be very specifically segregated out. The healthcare expenses generally aren't covered by PPP, so that's something that can go in. The family member stuff can't go into the ERC, so we can allocate as much PPP to the family member employees as well. But really, you think about anybody who made more than $10,000 over the period of ERC eligibility, all that excess can be covered by the PPP funding as well. So we have room to make sure that we are very specifically showing that there is no double count, that there was enough wages to cover both the PPP funding and the amount that can go into the ERC. Second question asked by the IRS in the IDR. It's very important that they want to see that you didn't double count. I think it's going to be their biggest area. I think that's going to be one of the biggest areas of IRS exams. And they're really going to look to see whether these taxpayers did reduce their deductions by the amount of the ERC, or whether they picked it up into taxable income. So
Marty, but that's amended returns for 2020 and 2021.
It is now. Yeah, it is now for sure. So if you haven't claimed it, you will have to do an amended return if you're an S Corp or a C Corp, or if you're a partnership, you may be able to do an administrative adjustment and do it in a more current year, whatever your rate is now. But yes.
And that's what, so today, in fact, the IRS issued a notice at 2023-40, and it's a renewed warning, which I've never seen in all my years of practice. But so it's the second warning about these ERC pop-up shops, third-party promoters, they're calling them. Again, radio, online, TikTok, TV. And something that they specifically mention is that wage deductions must be accounted for on tax returns. And again, those are going to be amended tax returns due to the time frame. So they also state, which I found pretty assertive, was that they're actively auditing, which we know, and conducting criminal investigations into some of these third-party promoters, and obviously by virtue of connection, their clients. So that's the most stern IRS notice I have seen in my years of practice. And again, just issued today. It's 2023-40.
Yeah, it's a good point. I've never seen the IRS put certain providers who shall remain nameless, but they know who they are, on double secret probation. So we're well aware, they're well aware of the fact that there's abuse in this area. So are we. And we sign these tax returns, and we want to get very clear on why a company qualifies. We're putting our name on it as well. We get to a more likely than not position that you qualify based on the facts and the law and the math of what the credit calculation is, and also what the gross receipts calculation is. So don't be afraid of it. You should claim it if you qualify for it. Absolutely. You should investigate whether you qualify for it. We've had time to think about this, to think about how supply chain disruptions are affecting the business. We now have data to think about what the lead time changes are. A lot of this sometimes isn't well understood until it's in retrospect, and you can see what happened to the business, and you have all the data to look at that now. So again, don't be afraid of it, but be wary of putting a claim in without being assured by your provider that you do qualify, and use a reputable provider. Other points here. Yeah, you can't double count with PPP. You also can't double count with the R&D credit. So to the extent you have wages going into the employee retention credit, and you also qualified for the research credit, you're going to want to put them to ERC because it's a much more generous credit. At the same time, you still need to track your attributes for R&D in terms of what was a qualified research expense in that year for future years, to track what your base amount is for that calculation. And just a little advertisement, tomorrow we're doing another one of these on Section 174 and some of the rule changes around research and experimentation. So I encourage everyone to visit that one tomorrow as well, another webinar. But again, we talked about this PPP. It's the most important thing is that your provider is aware of it, and that you're not double counting. And the way that we look at that is we take a look at what the forgiveness application was from the taxpayer. And so we can see what the cover period was, how much went to wages or other expenses. So we are appropriately calculating the ERC. Okay, hot topics. There's a number of them. Let's go to the end, statute of limitations here. This is most important. And this is the craziest thing I see in the advertising. Act now, or else you're going to lose out on your ability to claim an ERC if it's going to go away next week. Not at all. That's why everybody should take their time to think about whether or not they qualify. The 2020 ERC does not statutorily disappear for you to claim back for 2020 until April of 24. The 21 ERCs you can claim until April of 25. So you have time to look at this. The other, Carolyn hit on this, and I'm glad I did put it in my slides. Some of the things like PPP, restaurant revitalization, shuttered VAT are not treated as gross receipts. Income tax offset, good, I put that in slides as well. Again, we talked about this as well. You need to report this as a reduction to deductions in the amount of your ERC back in the past in either 20 or 21. Monetization, most of these now are just coming as checks from the IRS back for the 2020 and 2021 periods. They are paid with interest. So generally speaking, and we're moving away from the time you had to file it. So that's interest paid since the time you should have claimed it. So for large ERCs, a large amount of interest comes with it. Keep in mind though, you then have to reduce your deductions, and there's probably interest paid on the underpayment for income tax purposes. They match up pretty well. So the interest paid on the ERC may cover you for the interest you owe and the underpayment back in the past. PEOs, professional employment organizations, they generally file on their own employee identification number. So you don't have a 941 if you utilize a PEO. You still can claim the employee retention credit. And we work with a number of companies to determine their eligibility and for how long they are eligible and what the credits should be. But in the PEO context, the PEO actually has to pull the lever and do the filing on behalf of the taxpayer. So we can help in that case, but it's just not an amended return, a 941X that we'll file. It's rather a conversation with the PEO and generally an intake form that they have for purposes of self-identifying that you qualify for it and for what periods of eligibility you have. We talked about R&D and not double counting there as well. So those are some of the hot topics that we'll talk about. Other hot topics. Okay, so to the extent, and this is important, to the extent a company is owned in the private equity context, we think of private equity funds as owning a number of active trades or businesses. Just to shorten the technical analysis, generally speaking, and again, 9 times out of 10, but we need to take a look at the ownership structure. The fact that a PE fund owns multiple companies does not necessarily aggregate all those companies together under the control group rules. Generally, those trades or businesses and their direct subsidiaries can look at themselves independently because the fund itself is generally not considered to be an active trade or business and therefore breaks aggregation among all of the owned operating businesses under the private equity fund. Law firms are an area where we have focused due to court closures that directly impact the firm. For example, the location of work done by especially litigation firms is the location of the courts at times. And so to the extent there were court closures in 20 and 21 that delayed matters on the docket or in some cases delayed the ability to even have a trial or have live juries, there's the potential to investigate whether or not the law firm may be able to claim an employee retention credit, even if it didn't have the more than the significant declines in gross receipts. Again, I talked about tax exempt entities. They're not subject to the same control group rules. We generally just look at the EIN of the filer and identify what the gross receipts are there and how many employees they have. Government contractors, very interesting area. We have to look deep into what the government contractor does. We do this a lot for the R&D credit, but in ERC, it's also important to understand whether or not they're being paid under a firm fixed price agreement or maybe under a time and materials or cost plus agreement. At times, the government contractor, because they're being funded by the government doesn't want to fund wages that then go into a credit that the taxpayer pays. They essentially have to give it back. And so it may not be worth it as a government contractor to claim the ERC unless you can identify certain contract types, more often than not, work done under a firm fixed price arrangement, still may be worthy of it. Or so maybe maybe you have both, and so maybe a portion of the wages can go in. But we never look at the time tracking data to see exactly what the company's doing. Supply chain disruptions, I've talked about a number of times. Again, we look at the location of the supplier, we look at the flow of goods from outside the US, what transit they had, foreign mandates. Chinese ports had a lot of restrictions in 21. Mexican companies had a lot of restrictions in, especially maquiladoras and also just other operating production companies had a lot of restrictions specific to COVID in both 20 and 21. We've had a lot of luck with companies. I wouldn't say luck. We've had a lot of qualifying situations with companies where they've had goods imported to them from China and Mexico, where we can identify the specific supply chain disruptions and the length of them. All right. Okay. I don't know, Carol, if you want to talk a little bit about IRS exams and what they're asking for.
Sure. Again, hot topic. And as everyone knows, at the beginning of this year, the IRS was hiring and training a number of agents specifically to address ERC claims. We're just starting to see the fruits of that. Again, yesterday, Marty and I received our first IDR. Original forms 941, the basics of what we're seeing right now is it's not a full-blown audit. They're just matching the original form 941 and the 941X to address the amendment for the ERC. So basic matching, they're looking at the number of employees. So make sure if you're filing, you there's integrity between both of those documents. Again, as Marty mentioned, for PEOs, the PEO is going to be filing on behalf of the employer. The worksheet that is used to compute, I know as part of our documentation and our deliverable, we provide the worksheet. That is not sent with the amended 941, but do make sure that you retain that. They're asking for payroll journals. They want all the documentation that identifies and supports the employee retention credit, paid sick or family leave, a number of other credits. The wages associated with those cannot be used for ERC in addition to the PPP. They want all the details, right? We need to tell the story. We need to document statements and
the next slide has a good amount. There's two of this here, so we'll.
Thank you. Thank you. So these are all the things you need to retain. One important note is that at least for Q3 2021, the statute is not the 3 years, it's 5 years. So put these documents somewhere and put them aside, because it could be 5 years for Q3 2021 claims. Additionally, there is no statute for fraudulent claims. So, but back to the slide. So again, all of the calculations that determine the amount of the employee retention credit, the amount of wages, as Marty mentioned, be sure you're not double counting for ERC, for WOTC, for R&D tax credits. It's my belief that the initial IRS exams are going to hit really the high points. Number of employees. Did you file an amended return to reduce your deductions? And as claims are larger and as time passes, they're going to be digging a lot deeper into, if it wasn't a gross receipt claim, how the more than nominal portion was identified and connected to the governmental order.
Yeah, I think my philosophy on this is we know this better than the IRS does due to the fact that they haven't had the time and resources to dedicate toward these exams. So in the best interest of our clients, we really want to help the IRS by pulling together in our deliverables all this stuff. And it's always been part of what we've had as our overall deliverable to our clients. So the questions we see from the service and the IDRs are no surprise to us. It's everything we've been pulling the whole time. It may be differently ordered than the way we arranged it in our deliverable, but I'm hopeful that what we've pulled together is enough to just provide to the IRS. It will be well documented for them. But again, when that happens, I like to be specific with the service and not just throw a prepackaged thing at them. I like to answer the questions directly with exactly what they want. And so that's why we are performing audit support on behalf of our clients, because we did the audits early. We did them ahead of time. So we did it for the IRS when we did our deliverables for them. Maybe we'll leave it at that. Okay, our approach for clients. We've met so many wonderful new businesses and clients through the ERC program who we've then taken on to do additional work for. I've also had the opportunity to work with referral partners and other CPA firms who didn't have the time or expertise to help their clients around employee retention credits. We are fortunate to have a firm that has expertise in payroll and credits and wage credits and overall tax credits incentives group. But with that said, it doesn't make sense to charge a client before you know whether they qualify. It's really good to help clients out, help them understand exactly whether they qualify, why, what the potential benefit would be, and then provide, we'll call it a very fair fee that generally speaking is far less than I've seen. We can't do contingent fees here. It's not permitted for federal credits. And so we do a fixed fee arrangement that is generally significantly less than I've seen many of the consultancy providers that do contingent fees out there. They're charging between 15 and 20 to 25% at times. Ours is significantly lower than that because this is not our credit to take, it's yours to have, and we're providing a service. And again, so we'll do a complimentary scoping. We'll meet with the client. We'll ask them a number of questions. Let's move to the next slide so we can go through. We want to basically ask them for how many employees they had, who their payroll provider is. Did they get PPP once or twice? Get a copy of their gross receipts, get their story about how their business was affected by COVID, find out all their locations so we can identify the potential mandates that were there for why they had to operate in a certain way. And then pull together an estimate of what the benefit is, and then do a full information request. And I think that's on the next slide, where we will ask for your 941s, your 941s, the organization chart, how many family members are there, number of full-time employees, so we can do that count. The government mandates, generally we'll do that on behalf of our clients because we know where these government orders are if we understand what their story is. Gross receipts by quarter, the PPP forgiveness apps, the data, and then to do the project, this W-2 data that's detailed by person so we can understand exactly what the company was paying its employees and how much they got paid by paycheck date. So we can do our math to appropriately take out wages funded by PPP and keep in wages that were not, as we look at that. And so overall, that's the approach. And this is the data. And it's been really successful for clients and really, successful for us in terms of being able to meet new clients and work with them. All right, let's move to the next. These are the data requests, pretty much the exact same thing that was on the last slide. And so that is what we talk about when we scope these benefits. The org chart, the number of employees, the gross receipts, the government orders, the PPP docs, and the wage data. These are our talking points as we go through and scope out those benefits. And we can generally get a pretty accurate understanding of what the benefit could be before we even get into an engagement with the client. All right. One last polling question. Have you applied for the ERC? A, yes, all set. No, but interested. Nope, I don't qualify. Any answers are okay. But we'll have it, but make sure to fill out this polling question so that you can get the appropriate CPE. We're coming to a close. I think that's it. But I want to thank Maddie for helping do this, Lindsay, who helps me with marketing for my group, Carolyn very much, who helps me every day on everything, and then the entire group here within Tax Credits Incentives Advisory at Cherry Bekaert. ERC has been actually team building in a way. Wonderful people we brought on who then moved on to do things beyond the employee retention credit. We've expanded greatly as a result of this program and found wonderful people with whom to work. So, and wonderful clients as well. And I think we're getting done. Yes, that's it. So, Maddie, I don't know if there's anything I need to say at the end, but otherwise, I want to thank everybody for joining today.
Yeah, thank you both so much, Marty, Carolyn. Your insights, all the valuable information that you shared with us today. It was exceptional. Now, if you do have any questions for Marty or Carolyn, I did see we collected some throughout, so we have those and can follow up. But if you have any others, their contact information is on the slide in front of you. One last thing, we are sharing a short survey at the conclusion. We're always looking for ways to improve and gather some feedback. So if you could just go ahead and take that short survey. And as Marty mentioned, we do have more webinars coming up this week. Feel free to check out our page and sign up for any of those. So thank you again so much. Have a great rest of your day, and we'll talk to you again soon.
Thank you.
Thanks, everyone.